everyone. I'm Elizabeth Beattie, the head of the in-house lawyer services at HCR Law. Thank you for joining us today for this session focusing on business insurance. Businesses are open to a variety of claims, and avoiding common pitfalls is essential to maintaining good business relations and your place in the market. And in today's sessions, we will explore what you need to know, and that will include making sure your coverage is fit for your business needs, how to tell if your business is over or underinsured, the importance of giving consideration to business-specific risks and adapting to reflect evolving business needs, ensuring compliance with policy conditions, and understanding coverage limitations or gaps. Before we get going with the presentation from my colleague, bit of housekeeping. This is a Zoom webinar. It's being recorded so that it can be used on our website and for you to watch at a later date. It's intended to be interactive, so we'll have a short presentation from us, and then we'll open up the panel for questions and your comments. If you'd like to comment, you're comfortable asking questions on camera, then please do so. Alternatively, you can use the typed chat facility at the bottom of the screen to put any questions to our experts. The key for us today is that this is part of our ongoing series of value-added sessions for in-house lawyers. It's meant to be relaxed and allow you to have a chance to hear from and to pick the brains of our experts. What we'll do once, I'm going to hand over shortly to my colleague, Rose Burbery, who's an associate in our insurance team. And following her presentation, we'll open up the panel to field your questions. For the panel, Rose will be joined by another member of our dedicated insurance team, Rhiannon Willimont. So over to you, Rose. Thank you.
Thanks, Elizabeth. Good afternoon. As Elizabeth just mentioned, my name is Rose Burbery, and I'm presenting today with my colleague Rhiannon Willimont. Rhiannon might give a little wave to us. We're both in the insurance risk and regulatory team of HCR Law, which I'm sure you're already familiar with. So in terms of the background and the work that we perform, it's quite a wide range of work, including policy advice, policy reviews and disputes, as well as risk work, including a review of risks to businesses and how to reduce those risks specifically. So this is often in relation to health and safety or regulatory risks, but we also act for the insurer and insured policyholder in defending claims covered under insurance policies. So as we have this complete approach, it means we can be there every step of the way, from reviewing the risks when implementing policies, responding to those risks with control measures, responding to investigations by the health and safety executive or other regulatory bodies, assisting with claims such as for property damage, public liability or business interruption, and in the worst case, representing businesses at inquests. So the first place to start is with what keeps you up at night. So the purpose of insurance is to protect your business from risk and to prepare a financial safety net if the worst should happen. So any business or activity has risk, but the types of risks vary in their importance and they differ depending on the size and nature of the business. So the insurance has to fit your business needs, but before you can effectively protect your business, you need to identify the key risks to your business. And that essentially is what keeps you up at night. So you have to consider which risks would have a profound impact on your business, how catastrophic they would be, and how likely they are to occur. So for context, we perform a lot of risk work in the education sector. And whenever we are asked to assess a school, we see the general concerns of slips, trips and falls and property damage, which I'm sure is applicable to every business. But there are often the more serious concerns of pupil safeguarding and accidents on school trips, which clearly have the potential to be more catastrophic than a slip on the school premises. So speaking more generally, some of the common types of risks to all businesses include property damage, also loss of physical stock, death, illness or injury, defective products or advice, and cyber hacking or data breaches, which are certainly on the rise, and all of which can result in claims being made against your business or business interruption. Next slide, please, and I'll pass over to Rhiannon to discuss some of the next stages of what you need to consider.
Okay, thanks, Rose. So now you've identified the key risks to your business, you need to ensure that those risks are actually covered under your insurance policies. So the first stage is to carefully review your existing policies to understand exactly what it is that you're covered for. So is it quite easy to overlook any exclusions within your policy, but the impact of an exclusion might be devastating for your business. So recently, we've seen an increasing number of policies where the main risks to the business were actually excluded in the policies, and the business was left in a very vulnerable position. Our top exclusions or conditions to look out for are the identity of the insured party, territorial limits, and any conditions to extensions within the policy. Recently, a group approached us to check its insurance policies because they were planning to launch a new product. The group structure was a parent company with 3 subsidiaries. All business was conducted through its subsidiaries. When reviewing the policies, we noticed they were actually very comprehensive, but when we looked closer, we saw that the only insured party was the parent company. All 3 subsidiaries were actually uninsured. And as the bulk of the business was conducted through these subsidiaries, the business was actually opening itself up to a lot of risk, and it would have been unable to claim under its insurance policies. Another important exclusion to look out for is whether there are any territorial limits to your policy. So policies often have general territorial limits, and a common one is UK or worldwide, excluding the US and Canada. And the reason for that is because US and Canada is a lot more litigious than the UK and other territories around the world. So insurers often exclude those specifically. But we have seen some policies which have more extensive territorial limitations. So we carried out a policy review for a client and discovered that their business used to be UK based and they were sending engineers across the UK. They expanded into the EU and were sending engineers across lots of different EU companies. And whilst this was great for their business, their insurance policy actually specifically excluded claims arising from EU territories, which meant there was a significant proportion of their business that they weren't insured for. And the final point I'm going to cover in this topic is extension conditions. So in an insurance policy, you'll have your policy wording in your schedule, which will be the bulk of your insurance policy. And then you may also have extensions, which almost bolt onto the end of it and extend cover for specific circumstances. These can respond to specific risks within your business and offer additional peace of mind, but it's really important to check whether there are any conditions attached to these extensions. So one example of a recent case we've been working on is our client's insurance policy provided for cover for civil contractual claims. And so they were indemnified on the face of it for any claims arising out of commercial contracts. So at first glance, it seemed that this contractual liability they had to meet was covered. But when we actually looked at the policy, the contractual extension clause contained an exclusion so that the client would only be covered if they had first notified the insurer that they intended to enter into that contract and that the insurer had responded in writing to confirm that contract was covered. In this case, unfortunately, because there was no notification to insurer and no confirmation of cover, that contractual liability was not met under the insurance policy, and the business had to meet that liability itself. I'll now hand back over to Rose. Thank you.
Thanks. Next slide, please, Elizabeth. So following on from that, determining what you are actually covered for and what the insurer is willing to cover is based on the information provided to the insurer at the inception of the policy or the policy renewal. So under the Insurance Act, there is a duty to make a fair presentation of the risks, and this is a duty to disclose facts and circumstances that are material to an insurer's decision to offer insurance, and to accurately portray that information to the insurer. So this can have significant ramifications if it's not properly portrayed. We're currently instructed in a property damage claim by a policyholder, and the insurer investigated this claim and were about to confirm cover when they learned a director of the business had previously been disqualified from acting, which hadn't been disclosed to the insurer. So in these circumstances, the director's status had no bearing on the property damage, and the damage itself hadn't been caused by the director, but the insurer considered there hadn't been a fair presentation of the risks, and they ultimately avoided cover altogether in relation to the property damage claim. So the client had to meet the cost of the claim out of their own pocket. This is why it's of the utmost importance to provide accurate information to your broker and to your insurer. And so to do so, when arranging your insurance policy, your broker will ask you to complete and return a statement of fact. This sets out the important aspects of your business and risk profile, such as the type of business, the number of employees you have, your previous claims history, the size of your premises. It's very detailed and important to the insurer in all aspects, obviously. So the policy is then written on the basis of your responses in the statement of fact. If it becomes apparent to the insurer that the information you provided was not correct, or you withheld important information, which is referred to as material non-disclosure, the insurer may be entitled to either avoid the policy entirely, vary the terms of the policy, or charge an additional premium to you. Can I have the next slide, please? So hopefully now that you've provided the insurer with accurate information about your business and have a policy in place, it's important to thoroughly read and understand the policy wording. And even as an insurance lawyer, I can acknowledge that is not the most exciting task. But the importance of this is that insurance policies generally contain condition precedents. These are often onerous, but complying with them is crucial to maintaining cover under your policy. Failure to comply could entitle your insurer to decline cover in respect of specific claims, like the example I've just used, or to avoid the policy altogether. So there are two types of condition precedent to be aware of. The first one is condition precedents to risk, and the second is condition precedents to liability. So if a condition precedent to risk is not complied with, the insurer never comes on risk, and the insurance contract will be treated as having never come into existence, as though you hadn't taken out an insurance policy at all. So aside from having serious implications in the event of a claim, the fact the policy is treated as never having come into existence can also have a knock-on effect if any contracts held by your business require an insurance policy to be in place. So common examples of condition precedents to risk to be aware of is the condition to pay an insurance premium and the condition that the information provided before the policy in respect of known losses is correct. So the second example of the conditions to comply with is a condition precedent to liability, and they have the potential to be much more onerous. So a typical example of a condition precedent to liability is a claims condition which dictates when and how a claim or potential claim should be notified to the insurer. So these are condition precedents that can be often overlooked, as when you become aware of a claim, it's easy to focus on investigating the merits of that claim and engaging legal representation. This means that notifications to insurers are often made too late or to the wrong place, and the claim is not covered. So the consequence of not complying with a condition precedent to liability is that the insurer may be able to avoid cover for any claims made where there was a lack of compliance with that condition. So the policy is still in force, it's the specific claim that will be excluded. So we have a recent example of a product liability claim where we are acting for the policy holder. Under the terms of the policy, our client is meant to notify the insurer how many products they supply and the serial numbers of those products on a monthly basis, as well as providing details of any faulty products in order to make a claim for them under the policy. During COVID, our client was not able to collect the faulty products from customers due to lockdown restrictions. Post-lockdown, they've submitted a claim for those products which had been identified as being faulty during that period. The insurer unfortunately has maintained that the policyholder didn't comply with the condition precedent for monthly updates and refused to indemnify the claim as a condition precedent to liability. In that case, the policy continued, but the policyholder was preventing from making this specific claim. So this is an example of how literal insurers can be, as it was impossible for our client to comply with this condition precedent at the time, but the insurer still avoided cover. Can I have the next slide, please? I'm just going to hand over to Rhiannon again.
Thank you. So now you've informed your insurer and your broker about the details of your business at the inception or at renewal of your policy. But this duty to provide information to your insurer also extends throughout the period of your insurance. And this is called your duty to provide information for alteration to risk. And so your insurer will want to know whether there are any changes to your business which could change the risk factor, because that will depend whether or not they're more likely or less likely sometimes to have a claim brought under the policy, and whether or not they will have to pay out ultimately. So if insurers are not notified of any changes which they consider immaterial to your business, they may consider that the policy is void, and they may void specific claims presented under the policy. So examples of alteration to risk which should be notified to insurers are any changes to the control of your company. So if you have any internal restructures, such as changes to shareholdings, even if it's just different proportions rather than different shareholders. And definitely, if you anticipate the sale of your business, this should be notified to insurers at the earliest opportunity. And that's just to ensure that post-completion, insurance stays in place and the business isn't left without insurance. They would also be interested in any changes to location. So if, for example, your business is UK based and then you change and start providing goods or services elsewhere in the world, that would be something insurers would definitely want to know about as well. And one which is often overlooked, which is the introduction of a new product. So often in the build-up of research and design and actually launching a new product, it can be overlooked that you also have to notify your insurer if it's something new that you're breaking into and a new area, because the insurer will be interested as to whether they need to put other terms within the policy, or it might change the risk to the insurer. Could I have the next slide, please? So you've made sure that your statement of fact is correct, identified condition precedents, and how to comply with them. So what else do you need to do? So you need to carefully check your policy to see whether any exclusions apply. So insurance policies will have general wording, and the scope of the specific policy is defined in the schedule. So you have to look at the wording alongside the schedule to really understand exactly what it is that you're covered for and what exclusions might apply. When negotiating your insurance contract, you need to have a solid understanding of the risks to your business so that you can assess whether any specific exclusions are reasonable or not. So exclusions can cover a wide range of events. Sorry, there's just a siren outside. Ranging from war exclusions, which could exclude any claims arising from any acts of war, to specific property damage exclusions. For example, those caused by pollution or contaminants. And so a business, for example, which is located next to a factory which processes contaminants such as heavy metals or chemicals, will be less likely to accept a property damage exclusion for damage caused by contaminants than a business located in a quiet high street somewhere. Another example is that a business situated in, for example, the heart of London, maybe next to the Houses of Parliament or Buckingham Palace, might be less likely to accept a terrorism exclusion than a business in a small town in central England. And so it's imperative that businesses are aware of the exclusions that might apply. And a recent example of this involved a client which manufactures specialised components for the aerospace industry. On first glance, we looked at their insurance policies and thought that actually their product liability indemnity limit was a little bit too low for the size of a potential claim that they might face. And then we looked further into the policy and we realised that actually they had a specific exclusion for product liability for products supplied to the aerospace industry, which essentially was their whole business, the whole business that they carried out, which really left them open because any claims arising from defective products would just not be covered, and the business would have to meet these liabilities itself. So ultimately, depending on whether you accept an exclusion will depend on the specific business carried out by your company, the risks your company faces, and also your appetite for risk and how likely you think that risk is to occur. Can I have the next slide, please? Thank you, and over to Rose.
Thanks, Rhiannon. So far we've spoken largely about making sure your business is covered for key risks, but it's also the case that your business could be over or underinsured. So a review of your insurance documents, and specifically the statement of fact that we've spoken about previously, will assist in identifying if you're underinsured. Because if that document is no longer consistent with your business size, nature, or operations, there's a risk of underinsurance, and the insurer or broker should be informed as soon as possible to increase your cover and to make sure you aren't paying out of pocket over and above the indemnity limit in the event of a claim made against you. Recently, we were acting in an acquisition of a company and were asked to review the target's insurance policies and coverage. So that target performed fire protection work, which was the installation of fire stopping mechanisms, including fire doors and alarm systems. So on review of their public liability policy, we identified that they had a £10 million indemnity limit. And that might sound really high, and it might be sufficient for a business of a different nature, but the target was performing fire protection work on really large multi-story buildings. So given the nature of this work, there was a significant risk that if there was to be a defect with the work, it could lead to a catastrophic event, and obviously in particular a fire, resulting in massive amounts of litigation for property damage and personal injury to a large number of individuals. So in those circumstances, we considered that the target was likely underinsured for the type of work they were performing, and they required an excess insurance policy to be put in place. So insurance policies are obviously there to protect your business against liabilities. So conversely, it's also understandable why businesses would often enter into insurance policies which have really high indemnity limits. But this can lead to the opposite problem where businesses become overinsured. So we've recently seen a lot of policies where indemnity limits are seriously high. And in one piece of work, we had a business which in the last 4 years had only made one claim under its employer's liability policy, totaling just over £1,000. But they were insured for £40 million. Based on the business's claimed experience and the fact that standard indemnity for employers' liability policies is only £10 million, they were seriously overinsured. And the issue with being so overinsured is that the business has to pay for it. The broker should have advised them that the initial indemnity limit of £20 million was too high, but instead they suggested the business take out an excess policy for another £20 million. And the business had to pay heavy premiums for this, even though it was clear that that limit was not justified. Next slide, please. So when should you be reviewing your policies? You've got to make sure that they're covering those risks that are keeping you up at night. So obviously at the inception of the policy, you'll have provided all the information required to the broker and the insurer, and you should review at the commencement of the policy that it truly fits your business needs. At the end of the day, even though a business will have provided a significant amount of information and the broker should understand the business needs, no one is as familiar with the business as those involved in the day-to-day running of it. So following that, it's also important to check policies regularly to ensure they are and remain fit for the purpose and match the risk profile of the business. So this includes reviewing policies and, of course, advising the insurer when any material changes are made to the business structure or offerings, which Rhiannon has touched on previously, and in her specific example of the engineering business that started sending engineers over to the EU, that's certainly something that an insurer or broker would need to be aware of. So as she mentioned, these can include a change in ownership or directors, an increase in turnover or staff numbers, or supplying a new product or service to the market. But it's also really important at that point in time to review any new conditions imposed by the insurer in response to the increased or changed risks. So again, ensuring you're complying with any condition precedents. The main takeaway here is that if you wait too long and you wait to look at your insurance policies when a claim is being made and you find a gap in your coverage, it'll be too late and the insurer may be entitled to avoid the claim. So that's kind of a summary of the key things to look out for your business insurance policies, but I'll hand back over to Rhiannon, who has some practical tips and key takeaways here.
Thank you. Can I have the next slide, please? Thanks. So just to give a short summary of the points we've covered, so it's really critical for your business to really understand the key risks and picture what the worst case scenario might be for you, because this is where you want to ensure that you have sufficient insurance policies in place that will respond if a claim is brought against you. And it's important to really convey those risks and the nature of your business to your broker and the insurer to ensure that the coverage is appropriate for the business. And you also need to read the policy wording and schedules carefully to thoroughly understand the practical implications and the obligations imposed by those policy terms. And we also think it's really important to keep an open dialogue with your brokers and insurers to ensure you have the best possible outcomes. And then, updating them with any changes to your business could be as simple as a quick conversation with your broker, but could save you a lot of headache if you don't talk to them about it and then a claim arises. And we also advise that prevention is the best possible preparation your business can have. So if you look at your risks and see what you're actually covered for under your policies, if you kind of assess those risks and see what steps you can take to prevent that risk actually happening, that's often a really cost-effective way of actually bringing your risk rating down. And some of these steps won't be particularly financially onerous, and they might be quite simple to put in place. For example, in relation to employers' liability insurance policies, we find if you carry out regular reviews of your health and safety training you've provided to employees, and also risk assessments in place, and then if there are any control measures identified through those risk assessments, which you can easily put in place, actually that would make it less likely, probably, that you would have a claim arising under your employer's liability policy. And then in turn, when it comes to renewal, you might be in a better position. So when insurers look at your risk rating, they might offer you preferential terms or a decreased premium. So yeah, those are our main top tips for you. And yeah, we will now be more than happy to take any questions you might have.
Thank you very much, Rose and Rhiannon, for that really useful session. We've now got a chance for some questions to put to you, so I'll just let you draw breath. I've got a number of questions to work through before the hour is up. As I say, I'll let you jump in, you decide which ones you want to pick off. I think the first one I go is, question is, position is, what do we do if we fail to comply with a condition for an extension? Is there any way we can still claim under our policy?
So for this one, it will really depend on whether or not the condition is considered a general condition or a condition precedent. If it's a general condition that you've breached, if the insurer is going to decline cover, they need to establish that they've been prejudiced by your non-compliance. But if it's a condition precedent, the insurer doesn't have to establish that they've suffered any prejudice as a result of that non-compliance, and they can just turn around and avoid cover. Having said that, if the reason that you didn't comply with that condition was because you weren't aware it was a condition precedent, or you weren't aware of the extent of what you had to comply with, there may be other steps you can take, and we could offer specialist advice if that is the case.
That's great, thank you, Rhiannon. Another question I've got, slightly different tack, is a business that's quite acquisitive. So where we've acquired new businesses which sit as subsidiaries under the parent company, is there a way to ensure new acquisitions will be covered under our policies without having to go to the trouble of notifying the insurer each time?
Yeah, I'll jump in on this one as well. So yeah, it can be really onerous if you had to notify insurers each time you acquire a new subsidiary, if that's part of your business plan and you're growing your business. And that especially when subsidiaries have to be specifically named under your insurance policies. And this could require a lot of detail as well being provided to newly acquired businesses, which creates a lot of work behind the scenes, both for you and for your brokers. So one option you can do is to agree a subsidiary clause within your insurance policy. And that means that cover extends automatically to all subsidiaries of the insured party. So normally you would insure the parent company and then have a subsidiary clause. And that's one way of making sure that as soon as the acquisition completes, your subsidiary is covered under your existing policy. And we also recommend that even if you do have that in place, you just check for any exclusion clauses, because there might, for example, be exclusions about if you're acquiring a non-UK subsidiary or something along those lines, or maybe specific sectors might be excluded. But as a good way to mitigate that extra work is to have a subsidiary clause within your policy.
That's great, thank you. Slightly different tack this time. Insurance broker, obviously it's an important relationship. What tips do you have if you're not satisfied with the service from the broker or the quotations that you've received? I don't know if Rose, do you want to jump in on that one?
Yeah, I can take this one if you like.
Yeah.
So in the first instance, obviously you should have a frank discussion with your broker about your satisfaction with them and also about your business's risk, because it might be that they just don't understand specifically what it is that your issue is and what you're trying to seek cover for and the type of cover that you actually require in relation to your business. But I would say probably one of the more common issues we hear about are that businesses are not satisfied with the premiums that they've been quoted. And often that's because they're much higher than they would have expected. And in the first instance, I would expect the broker would be able to explain why this is. But this could range from anything within the sector, specifically where the business operates, and the business itself's claims experience. So lately we've seen, and this has been all over the news, different cyber hacking issues, data breaches. So it might be the case that your cyber or technology policy premium has significantly increased just in response to what's happening in the wider market and not specifically what's happening with your business. So if there's a concern about that, it's definitely worth speaking with your broker first, just in case it's something that can be explained quite easily. But otherwise, obviously, we see a lot of the time that if you're not satisfied with your broker, you can kind of search the market for something that's more suitable for your business needs.
Just out of interest, because I sort of organise with insurance policies myself, and I wondered whether it's your experience. I would say to the broker, right, what are the key things that insurers are looking for when you're preparing all your submission for them? What is it that they want to see or want to hear, so that you can effectively, if you end up with sort of talking to them or a beauty parade with other underwriters, that you can appeal to their better nature or to whatever issue is the hot topic, and you can present how you deal with it in the business so that you can satisfy them to try and minimise that ever increasing cost of insurance. Is that something you've experienced as well, Rose?
Yes, certainly. And the brokers, most of the time, I would say 99% of the time, have a really good relationship with the insurers. So if there's a reason that the premium has gone up, it might not necessarily be in their hands, but they should be able to kind of work those relationships and get you the best possible outcome as well. But certainly it's a complaint we've heard a lot lately about the increase in premiums, because obviously the cost of living crisis and fluctuations in the economy also have a lot to do with it. And so like any yearly subscription, they do tend to go up year to year, regardless of any kind of external influencing factors as well. So that's something to kind of factor into your business modelling and budgeting.
And if I could just add something, taking on from what Elizabeth said, that's one of the reasons why it's so important to kind of respond to risks you've identified within your business, because actually when you speak to your broker, they might, a reason why a premium might be so high is in relation to a very specific risk. Where if you can demonstrate that actually you're fully aware of that risk to your business, and you actually have all different control measures in place, and you have, you're really responding to that risk, that might give the insurer some comfort in relation to it, which might also help just with your premium negotiations as well.
That's great, thank you very much. Next question I've got here is, how can I know whether the policy limits suggested by insurers are reasonable? Who's going to take that one?
I can take that one.
Thank you.
So the best place to start for that is your own claims experience. So look at the value of the claims you've had over the last 5 years, and whether the annual limit suggested by the insurer is reasonable in that context. I think we had mentioned an example earlier of a really overinsured business who had only made a claim worth £1,000. So the policy limit needs to take into account what it is that you've actually claimed previously and what it is that your business is doing. So you have to look at the potential value of the claims insured to see whether it's appropriate to have that level of coverage. But it's also important to look at whether your policy limit is per claim or in the aggregate. So in the aggregate means that the policy limit is the most the insurer will pay out during the policy period, which for business insurance tends to be 1-year periods that are renewed annually. So each claim under that policy chips away at that limit that you can spend. And once it's reached, the insurer won't meet the indemnity for any further claims, so that they're coming out of the business's pocket. Whereas obviously per claim is how it is on the box, so per claim. But if it's per claim, you might not need such a high limit, as obviously there's a cap generally on how much each claim is going to be worth, but that just depends on the nature of the business itself as well.
Okay, that's helpful. Thank you very much. A sort of practical question here completely for you is, how can a business ensure conditions in the policies are complied with? I mean, it's quite a loaded question depending on the nature of the business. So I suppose it may be a question of, as you've already mentioned, identifying your risks and then ensuring you've got policies and that those are being policed. But do you want to sort of take us through your sort of top tips in relation to dealing with that?
Yeah, so I think it's actually looking within your business and who else actually going to have to be complying with these risks. So they might be that these conditions are complied with at board level, in which case you just need to make sure that the board is fully aware of any conditions you have to comply with. But we have seen some condition precedents, which actually depend on employees' actions. So an example that we have seen is a motor trade policy, which provided that any claims arising out of any hot work, which is kind of anything using specifically hot, like kind of welding, all of that kind of fabrication, only claims which follow a specific procedure that was actually set out within the policy as a kind of use of heat procedure would be covered. And so in order to ensure that you're complying with that condition, then our client then kind of rolled out a series of training regimes kind of across their business, just to make sure that all of their employees who were actually carrying out day-to-day activities through the business knew the importance of actually following that set procedure, because it can be quite easy, you know, if they've got already a procedure that works really well in place, but actually this procedure, which was included within the insurance policy, included an extra couple of conditions that they wouldn't normally comply with, they might kind of overlook them and not do them. But actually that could mean that any claims arising wouldn't be covered. So it's just really about identifying who within your business actually needs to respond to those conditions and making sure that they've got the best in the best position they can be to actually comply with them.
I mean,
and just to jump on that, that's the importance of reading the policy and all the conditions. And that way, whoever's doing that for the business can delegate those tasks down, because otherwise you find, you know, if someone's reading, for example, the hot work condition and they don't perform hot work, but they're not communicating that on, that's when problems arise. So it's about having one person communicate this across to the company, across to the board, and then figuring out what to do in terms of implementing that across employees as well.
I mean, out of interest, do you find situations where a company may have got a really good portfolio of insurance cover, but they haven't actually had someone police the compliance with the relevant conditions, or they've let themselves down? Is that something you see quite often?
Yeah, it is. And that's kind of going to what Rose said. You know, they've got someone at board level who is so on top of it all, and they've arranged great insurance that responds to all the business risks, and you know, they think that they're in a really, really strong position. But actually, when they actually drill down into it, they might have gaps of non-compliance just because that hasn't been that hasn't been communicated down. And that might arise, you might become aware of that, not through any insurance review, but just kind of a general audit, health and safety audit, for example. And that's why it's very important to have someone who's, actually looking at how practically these insurance policies affect your business, and who actually needs to be complying with conditions, and who those insurance policies actually affect in day to day.
Great, thank you. A question for you is, if we provide here incorrect information on a statement of fact, does that automatically make the policy void?
The answer to that is a little bit of it depends. So I would say no in the first instance, but it does depend on the importance of the information. And we had that example previously where not voided, but a policy was excluded. A claim was excluded on the basis that they hadn't provided information about the director's status, even though it was completely irrelevant to the claim itself. So that's why it's really important to review the statement of fact and provide information as accurate as possible. I would say if the incorrect information provided is intentional, certainly that the policy might be void if the insurer becomes aware of this. But otherwise, they might just seek to vary the terms of the policy or apply an additional premium if it's the case that something you excluded makes a difference to the risk profile of the business.
Yeah, that's great. I've got one final question for you here. It's sort of what in your view is sort of the main challenges for businesses when claiming under an insurance policy? I know we've touched on this, but I don't know if you just want to reiterate that. Who's going to pick that one?
Yeah, I can jump in if you like.
Okay.
That is very broad, so it could cover a large number of things, but in my experience, largely not complying with conditions appropriately, which does create coverage issues. So obviously we do all manner of work, and we do address risks and review risk and risk control for businesses. But as is human nature, often we don't become involved until a business has a problem. And it's dealing with that problem that we often see a lack of coverage, so not the right level of indemnity cover for whatever the issue is, or a failure to comply with the conditions. And so that's the part where disputes arise, obviously, because otherwise, if you've completely complied, your coverage is perfect, then you have a claim with no hitches and you don't need us. So it's in those kind of instances that we often get involved. I'm not sure if Rhiannon has any other experiences.
No, just really along those lines. The main challenges are really identifying the risks and actually making sure they're appropriate for your business. For example, if you are, for example, a maintenance company and you maintain work vehicles, that kind of thing, you want to make sure that your policy includes kind of coverage for outside spaces. So, for example, if you have a yard where you carry out work, that kind of thing. Whereas other policies might only include property damage claims within a locked building. And you just need to just make sure you have a look through your policy and make sure that actually the terms within your policy are actually really appropriate for your business, because sometimes that can be where we see gaps.
The question I've got is it fair to say, because some businesses might put greater reliance on their broker to advise them what they need, and in fact you don't know, unless you've got a very good relationship with the broker, it's very specialist stuff, that the broker fully understands your business needs, and then you've paid up and you've done everything you're supposed to, you've complied with it all, but you find that the cover isn't the right fit for you, it doesn't cover all that you need. Is that something that you've got experience of too?
Yeah, we unfortunately do see this quite a lot, actually, where someone's gone to a broker to arrange cover for their business, and actually they've kind of been given an off-the-shelf policy which is specific to their business and actually isn't quite appropriate. So the example I was actually just talking about there, our client carried out business and it was a locked yard, but they suffered property damage, and their policy actually limited any claims for property damage to property damage that occurred within a locked building. So they just weren't covered in that instance. And so in that case, it becomes, what information did the broker ask you about in that instance when you were arranging cover? What information did you provide to the broker? And then, so we have seen quite a few policies that actually, if there was better communication from the outset with the broker, a lot of these issues would have been avoided. And I think that's when the communication is key. So even if you're not arranging very specialist insurance, really making sure that whoever is your point of contact within the broker just really understands exactly where you're coming from and what you want to achieve with your insurance policies. And that could save you a lot of headache down the road.
Yeah, I would agree with your comment about off-the-shelf insurance policies, and I would say for insurance, it's definitely not one size fits all. And that's also why there are brokers that specialize in specific industries only. So you don't want someone who works only in the retail sector providing insurance policies for your, multi-party construction contract like situation that you have, because they don't necessarily understand the ins and outs of that business and what you specifically would need to be insured for.
Would you also think that when it's appropriate, that it makes sense for the broker, a new broker or existing broker, to come on site and actually see what's what? So there's a chance they're trying to understand what they're selling you, that they can actually see how your business operates. As you say, whether it's an outdoor yard, indoor yard, whatever it might be, that actually, if you don't have, would it occur to anyone to have that conversation? But obviously you had an on-site visit and they actually walked around and had a good look and talked to people, they would get a better understanding of exactly what it is you need and what they're selling you.
Yeah, definitely, especially for industries where you actually have quite, you have physical premises, especially like in the manufacturing industry, or if you have, construction industry especially. It's really informative, because a lot of the nuances of your business probably don't come out just reading some information on a screen. Only actually go and visit and see how it is that they actually operate in reality. That can just be such a valuable experience, and can really help the broker understand exactly what you need. And so I think, that's a really, really good suggestion. Try and get your broker to come and visit, and then also that will help with your relationship with the broker as well. And so, any issues that arise, down the line, if you've got, a strong relationship with your broker in place, that's only going to help you if you need to contact them about any coverage issues.
Okay, that's great. Well, look, we've exhausted all of our questions. So I'd just like to say a big thank you to Rose and to Rhiannon for a really useful session today. I hope that you found it useful. As I say, this is being recorded, so it's available to revisit and to sort of work through the answers and information provided today. Thank you for joining us. I hope you'll continue to join us at future sessions. These run each month and on a wealth of topics. But for the moment, speak to you soon, and thanks again for joining us. Bye for now.
Thanks very much.